Welcome to MBCC Trading Highlights podcast number 25. The market has become one big casino. Most people, when they talk about being in a bull market or bear market, really only look at the S&P 500 when making that statement. If that or the Nasdaq was the only index they ever saw, then sure, they could be mistaken for thinking that we are in the midst of a whole new bull market era. There is a saying, the market is not the economy. If one were to look at the other real indices of the market like the Russell 2000, the small caps or the mid caps, China, or even other sectors or industries, there are just a handful of names driving the top level indices higher, the Magnificent Seven. Back in November, we had about 4 or 5 names going higher every day. Today, it is pretty much just one name, Nvidia. And then we have SMCI in the Russell 2000. Between these two names, the market is either up or down based on what the stock is doing on that day. So to recap, let's go back a few months. The market was breaking down last year after the summer as the Fed was increasing rates at a rapid rate and they caused havoc in the bond markets. We saw the US 10-year bond get to 5% plus on the yields. The US regional banks failed due to this mispricing as their assets and liabilities were not matched early in the year. Rates rose a lot faster than anyone expected. And lo and behold, Yellen came out and played tricks with their bond issuance that caused a massive bond market rally in November, taking equities along with it. But make no mistake, the US debt is on an unsustainable path. Biden's economics is based on basically printing money and spending to no end. The US borrowed another $260 billion last month. On an annualized basis, this puts the US on track to borrow $3.1 trillion in just 2024. Total US debt now stands at a record $34.3 trillion. That's 2.8 times the market cap of just the Magnificent Seven stocks. So in a nutshell, there is a lot more treasury issuance to come as it needs to be funded somehow. Yellen has used all her tricks right now as she has even drained down the reverse repo account down to the last 500 billion. As we head into March, when the BTFP program ends on the 11th, it remains to be seen how they will handle the ongoing banking crisis. As a reminder, the BTFP was a program that was initiated by the Fed last year during the US regional bank crisis that allowed banks to borrow at par against all their assets no matter what losses they were holding on the balance sheets. So the Fed pretty much wrote them all a check, while mainstream media is talking about how the Fed has done such a great job at reducing their balance sheet by $1.5 trillion. Make no mistake, the Fed injected a good $2 trillion easily through the financial system against this. So we really have not seen any liquidity tightening that the market's been talking about. Even with all of this, banks have not been able to lend out as it is just too risky, and consumers are unable to take mortgages as rates are too high. They are stuck with their old levels of interest rates because they cannot afford new homes lest they lose that rate. Commercial real estate, which is classified as a very single stock asset specific risk exposure, we are now seeing multiple buildings being offloaded at 10 to 20 cents on the dollar or just being closed down. A lot of these new loans are meant to be refinanced this year and their rates will be a lot higher. This leads to even further tightening amongst the banks that have access or exposure to these loans. Consumer credit cards are maxed out. Real wages are just not able to keep up with inflation, which is close to 3%, nowhere close to the Fed's 2% goal. The bulls keep talking about the labor market and how it's held up so well. It is astonishing because each company that we hear on the Q4 conference call is laying off about 20 to 30% of its workforce, yet the numbers just don't show any pickup in jobless claims. If one looks underneath the hood, we see a lot of part-time work that's picked up, not full-time jobs. People are taking 2 or more jobs just to keep up and be able to spend. A lot of foreign workers are taking those jobs as well. Either way, as we entered Q1, data is showing signs of plateauing now. After years of Biden's massive fiscal spend post-COVID, this caused a recovery, but even that is showing signs of cooling off now. The cost to service US debt, just right now, this year is in excess of $1 trillion. So now we need to print more money just to pay off the old debt. Forget about productivity or growth. All bets are placed on this recent AI boom that will or is expected to magically fill that productivity gap that everyone has penciled in for in earnings this year. No doubt there will be productivity, but to price the future 5 years today is just a bit preemptive. Fiscal year 24 earnings have been trending down, even including the top 7 names. If we exclude those, then the fiscal year 24 earnings going forward is actually trending down. The sales and EPS of these 493 members are actually declining. Smaller companies are going bankrupt. The Fed needs to cut rates, but it cannot, as inflation will go back above 4 or 5% and it will kill the system. They cannot afford that risk. It'll be the first time if they cut now at market all-time highs, this has never been heard of. They need to, but they don't have the justification to do so just yet. Can you imagine what will happen the next time we have a financial hiccup? Do we just print another $20 trillion? Starting this year, we saw massive buys and charts looking parabolic in names like Nvidia, which beat earnings by $2 billion but caused a rally in its market cap of $250 billion. It just doesn't add up. And now, over the last few days, we've seen Bitcoin up 50% over the last few weeks due to the massive inflows into its ETF, and this is causing shorts to bail out. The charts are looking massively parabolic. There is massive disconnect between what the equity markets and bond markets are pricing in for future rate cuts. Equity sell-side analysts and traders expect about 4 to 7 rate cuts. We were almost at 7 plus starting this year. The bond market is pricing about 4, and every day we get stronger data, it's pricing in less and less. The Fed is sticking to its commitment of 3 rate cuts this year that it alerted us in December of last year. Day by day, as we get the data looking more stagflationary, which means growth is rolling off and inflation and prices paid is staying stickier, this means the Fed's job has gotten even harder. We are in an election year, so that makes things a bit confusing as the data will be massaged and manipulated to suit the Biden admin. But there is very little room to spend more. The average American, as we saw in the US consumer confidence, is bailing and finding things a lot harder going forward. So how do we trade these markets? What are the setups into March for commodities? Where is oil headed? We know OPEC Plus has done a great job keeping 6 million barrels per day of oil out of the market and sort of put a floor underneath the market and possibly looking to extend its output cuts. But is China demand back? Is it growing or holding back? Gold, silver, copper, iron ore, all these commodities remain stuck right now. We discussed this in our note to our paid subscribers as to what we expect and what the catalysts are in the physical market into the next 3 months. Thank you so much for tuning in today. To get access to our live daily trading newsletter and our action ideas, please do send an email to info@mbcommoditycorner.com or hit the subscribe button and join us via Substacks link at mbcommoditycorner.substacks.com. We look at commodities, as the readers know, we look at commodities from a multi-pronged approach. We look at not only top-down but bottoms-up and technical as well. Commodities can no longer be looked at in isolation. Yes, they are driven by physical market analysis, demand-supply balances, but macro does play a very big role. For instance, the oil market right now has been stuck at $80 to $83 a barrel right now. We have OPEC Plus that's underpinning the market with this 6 million barrels per day of oil that's been on the sidelines, but then top-down is held back by Chinese slowdown, the global slowdown that we're seeing witnessing in the US and EU in terms of demand. All these factors come into play. MBCC really is a cross-asset relative value arbitrage fund. We look at 25 different quantitative factors and see what themes emanate from different asset classes and what each asset class is pricing for a certain factor. Then we look at those valuation discrepancies to pinpoint how to play those discrepancies across assets. We not only look at from a top-down approach, but bottoms-up and technical analysis, combining derivatives and all sorts of analysis to really pinpoint on what the trading idea is. March is going to be a very interesting month, so please do sign up and we can walk you through in terms of what our daily ideas on oil, gold, silver, Bitcoin, and all these sort of ideas are going forward. There is a big disconnect in the market right now in terms of growth, recession, and slowdown. We talk about all this and more. We hope you enjoyed the video today, and we look forward to seeing you all the next time. Thank you so much.